Welcome back to the deep dive. Our goal today is to really cut through all the noise from the week of November 17th to the 24th. We're going to distill it all down so you can get up to speed quickly and, really understand what's driving things.
And this week, if you look at everything, it all comes back to one thing. The U.S. consumer. They are just front and center. But the weird part is we're trying to figure them out in this kind of fog of data uncertainty.
Right. That fog is the key. And it really dictates how we're going to structure this whole deep dive. We're going to start with the strange puzzle of missing economic data.
Mm-hmm.
Then we'll get into the dramatic shift in what everyone expects the Fed to do.
An almost irrational shift, really.
Exactly. And finally, we'll try to decode the American shopper by looking at how some retail stocks did great and others, well, not so much.
Yeah. The sources we dug into really highlighted how tough this moment is. One of them actually described it as dealing with, and I'm quoting here, bad data, missing data, late data, and holiday-distorted data.
Wow. So when your inputs are that messy, you have to pay really close attention to the few signals that do break through.
You really do.
Okay, so let's unpack that data puzzle, starting with the job market. We finally got the September jobs report, which feels like ancient history because of the government shutdown delay.
It does. And the numbers themselves were just a classic mixed signal. So on the surface, jobs added looked strong. 119,000.
Which was way more than expected, right?
Way more. More than double the 53,000 people we're looking for. But, and this is a big but, the prior month was revised down by 26,000 jobs, landing at negative 4,000.
So basically, the new strength was just making up for previously unreported weakness.
Precisely. And it gets even more nuanced when you look at where those new jobs actually came from.
That's what I was going to ask. It wasn't a broad-based thing.
Not at all. You can think of it as two separate engines.
Yeah.
One is running strong. That's healthcare, leisure. But the other engine, it's sputtering.
You mean manufacturing, transportation?
Yep. Manufacturing, transportation, business services. We saw a lot of layoff announcements from those sectors. So it's not a boom. It's a very specific, concentrated pocket of hiring.
Okay, now let's talk about the unemployment rate, because on paper, that number got worse. It went up to 4.4%.
It did, versus the 4.3% expected.
So that sounds bad, but I heard a lot of analysts were actually kind of relieved by it. What's going on there?
It's one of those totally counterintuitive economic things. The rate went up for, believe it or not, a good reason.
Okay, explain that.
It was caused by the participation rate going up.
Right, so that's the number of people either working or actively looking for a job.
Exactly. So when that number goes up, it means people who had been on the sidelines, maybe they were discouraged, maybe taking care of family, they're now feeling confident enough to start looking for work again.
And when they first start looking, they're technically counted as unemployed until they find something.
You got it. So the unemployment rate ticks up for a moment, but it's actually a signal of deeper health and confidence in the labor force. A very positive sign, weirdly enough.
That's a great insight. But this bigger data puzzle is still there because of what's, well, completely missing. We didn't even get an October jobs report.
Nope. They just skipped it. The Bureau of Labor Statistics is rolling it into the November report.
And here's the timing problem. That combined report won't be out until after the Fed's big December meeting.
That's the critical issue. That and the Consumer Price Index, the main inflation number, also missing until after the meeting. So the Fed is making this huge decision on rates with a giant recent blind spot in their data.
So if the CPI is gone, what is everyone going to be watching this week on November 25th for clues on inflation?
We have to shift focus. Instead of the CPI, we're all going to be watching the Producer Price Index, the PPI.
Which is the wholesale prices, right?
Yeah.
Before they get to the consumer.
Exactly. It's an upstream indicator. But in a vacuum like this, it becomes incredibly important. If PPI comes in hot, that's a bad sign. It means inflation is probably heading our way. We'll also be watching retail sales and consumer confidence very, very closely.
Because in the end, it all comes back to the consumer.
It's the ultimate swing factor right now.
It seems like the market, faced with all this uncertainty, just decided to latch onto any good news it could find. Which brings us to the Fed. The minutes from their last meeting showed they were really divided on a rate cut, but the market just ignored that.
Completely ignored it. The division was real. You could see a genuine debate happening. But with no hard data to go on, the market just seized on some dovish comments from a couple of key Fed members.
You're talking about Christopher Waller and John Williams.
Yep. Their comments just got amplified because there was nothing to contradict them.
Yeah.
And that became the catalyst for this huge aggressive repricing of what the Fed's going to do.
And when you say dramatic, I mean the numbers are just staggering. The odds of a quarter-point rate cut in December went from 45% to 81% in 1 week.
81%, yeah. The market basically just declared the debate over and said a cut is happening.
Isn't that kind of irrational given everything we just said about the missing data?
The market wants lower rates so badly, and those comments gave it permission to start pricing it in as a done deal.
And you saw that immediately in the bond market.
Instantly, bonds rallied hard. The big one to watch, the 10-year Treasury yield, it fell almost 10 basis points. It closed the week at 4.03%.
So it's knocking on the door of that 4% level. Why is 4% such a magic number for the 10-year?
It's just a huge psychological line in the sand. The 10-year yield is, the bedrock rate for everything. Mortgages, corporate debt, stock valuations.
Yeah.
If it breaks below 4% and stays there, it's the market saying, okay, the Fed is done. The inflation fight is over. It also suggests maybe long-term growth is slowing a bit. But the big thing is it makes future company earnings more valuable today, which is hugely bullish for stocks.
That really puts the market's rally into perspective. Okay, let's circle back to our main theme then. The consumer. Because retail stocks gave us a completely fragmented picture.
It was the perfect illustration of that idea that you just can't make broad statements about the American consumer right now. They're acting like what one source called a selective bargain hunter.
Rewarding some companies and punishing others.
Exactly, all based on value. Let's look at the winners. You had Walmart, the ultimate value play, up 1.1%. And then TJ Maxx, which is all about that treasure hunt bargain feel, it surged 2.5%.
Okay, so they did well, but then you had Target, which struggled, down 4.5%. And the home goods sector was really telling.
Oh, that split was fascinating. You had Lowe's up 1.7%, doing fine. But Home Depot got hammered, down 6.0%. So it seems like consumers are still spending on needs, but pulling way back on the big wants. The takeaway is you just can't invest in retail. You have to know exactly where a company sits in that consumer's mind.
So it's a micro story, not a macro one.
Entirely.
Okay, speaking of specific stories, let's talk about the stock market itself. Because there was this intense tug of war happening within tech, specifically the Magnificent Seven.
Yeah, U.S. stocks were actually down for most of the week. And it was because those big AI-driven tech names were continuing to sell off.
Even after NVIDIA had great earnings.
Even after that. The report was strong, but it couldn't stop the selling, at least not initially. The market only staged that big rally at the end of the week because of the Fed comments. It felt like it was just looking for an excuse to buy.
So let's look at the Mag 7 since the market peaked on October 28th. The S&P 500 is down about 2.7% since then. How did that group perform?
Well, the key is there is no group anymore. There was a massive split. 4 of them were really dragging the market down. Meta was down a staggering 18.4%.
Wow.
Yeah. Microsoft down 12.6%. NVIDIA and Tesla both down over 9%. These are serious corrections.
So who was holding up? Who bucked the trend?
Really only 2 of them. Alphabet was actually up 19.1%, and Apple was up a more modest 2.6%.
So the lesson is it's not one monolithic block anymore. You have to look at them individually.
Absolutely.
Now, what about beyond the giants? Looking at the broader market segments for the week.
This is where you can really see that anticipation of rate cuts. Small cap stocks were the undisputed winners. They were up a huge 3.1%.
And that blew everything else away.
Everything. Large caps were up just 0.5%. Growth stocks, 0.4%. The NASDAQ, only 0.7%. Small caps were the story.
Why are they so much more sensitive to rate cut expectations?
It's all about their balance sheets. Small companies tend to have more debt relative to their size, and often it's floating rate debt. So when the market suddenly prices in an 81% chance of a rate cut,
their future interest payments immediately look a lot smaller.
Precisely. It boosts their projected profits way more on a percentage basis than it does for a cash-rich giant like Apple. So any hint of a dovish Fed sends them soaring.
That makes perfect sense. So let's connect that U.S. optimism to the rest of the world. How did international markets do?
They lagged badly. Developed market stocks were down 1.4%, and emerging markets were down 1.2%.
So the U.S. rally was happening in a vacuum.
It was. Now, part of that is just timing the news about the Fed pivot hit after a lot of those markets had already closed.
But that can't be the whole story. Why wouldn't that optimism spill over?
That's the real question, isn't it? It suggests that international markets are maybe dealing with their own local problems, or they're just more skeptical that the U.S. recovery is a sign of a global recovery. For this week at least, the S&P 500's rally was a very American story.
And that brings us to the end of this deep dive. We went from this fog of missing data and anxiety to an 81% bet on a Fed rate cut, all while the consumer is being incredibly picky.
And I think the key thing for you to take away is the detail behind those headlines. Knowing why a rising unemployment rate can be good news, or knowing that the Mag 7 is really two different groups right now, that's the kind of depth that helps you see past the noise.
Absolutely. Something to think about. Thanks for diving deep with us.
We'll catch you next week.